Japan's energy delegation traveled to Alberta, not Texas, not the Gulf of Mexico, not Riyadh. The choice of location carries significance that extends far beyond the current price of crude. Reports that emerged in August 2025 were preliminary, technically detailed, and barely noted outside specialized Canadian energy publications. Alberta was in initial discussions with Japanese refining firms about a joint venture centered on a coker unit, a heavy industrial facility designed to handle the most sulfur-rich, viscous fractions of crude oil that ordinary refinery distillation cannot process. Without such a unit, Japanese refineries are unable to handle Alberta's bitumen crude. Alberta bitumen is extracted at an API gravity of roughly 8 to 11 degrees, making it one of the heaviest crude grades produced globally, with a sulfur content between 4 and 7% in its raw state. Japanese refineries, in contrast, were built over decades to process medium-sour Persian Gulf crude, with API gravities between 25 and 35 degrees. The two are incompatible at scale. The coker unit serves as the essential bridge. What Alberta proposed was not merely finding a new buyer for its crude. It aimed to fund part of Japan's refinery adaptation, absorbing capital risk within Japanese industrial infrastructure to establish a permanent, multi-generation purchasing relationship. This represented the first time in Alberta's 114-year oil industry history that the province considered investing in energy infrastructure on foreign soil. Japan's role as a buyer is critical, given the scale of its structural energy challenges, which are often underestimated outside energy security circles. Japan consumes 2.36 million barrels of crude daily, but produces only about 15% of its own energy. The remaining 85% relies entirely on imports delivered without disruption. Of these imports, 93% pass through the Strait of Hormuz, the 33-kilometer-wide passage between Iran and Oman, where roughly 20 million barrels of oil transit each day through a highly contested military corridor. The United Arab Emirates provides 43% of Japan's crude, Saudi Arabia contributes 39%, and Kuwait and Qatar supply most of the remainder. This means the third largest economy globally, whose automotive manufacturing, petrochemical sector, and electricity generation all depend on uninterrupted crude, is reliant on output from 4 nations in a historically volatile region. In early 2026, the Tokyo-based Institute of Energy Economics rated Japan with the highest supply disruption risk score for the Strait of Hormuz among major importers, 6.4, compared with China at 5.8 and South Korea at 5.1. This is a current assessment, not a projection, reflecting a structural vulnerability embedded over 40 years. Alternative sources were long considered too costly and logistically distant to pursue seriously until Trans Mountain altered the economics. In March 2025, Alberta's Energy Minister Brian Jean confirmed ongoing discussions with Japan, South Korea, and European nations about diversifying oil exports. Media coverage initially focused on the obvious narrative. On February 1st, 2025, the Trump administration imposed a 10% tariff on Canadian energy exports as part of a broader 25% tariff on other Canadian goods. Alberta, supplying 87% of Canada's U.S. oil exports and channeling roughly 90% of the country's 4.4 million barrel daily production directly to American refineries, had a clear incentive to explore other markets. Yet the coker unit detail revealed a far deeper strategy. Alberta was not simply signing purchase agreements with Asian buyers. It was offering provincial capital to co-finance industrial modifications, enabling Japanese refineries to permanently process Alberta crude. This distinction separates a temporary pricing opportunity from a structural supply chain realignment capable of outlasting governments, trade walls, and tariff policies. A single industrial coker unit represents hundreds of millions of dollars in capital investment. Its design, permitting, and construction spans several years. A refinery that installs one optimized for Alberta bitumen makes a commitment measured in decades, irreversible, like a spot contract or pricing deal. By contributing to this construction cost, Alberta was requesting Japan to treat its crude as a fundamental supply input, offering capital to secure permanence. The prevailing assumption since Trans Mountain's expansion completion in May 2024 was that Asian market access was a long-term geopolitical goal. The fact that 90% of Canadian oil exports flow to the United States is shaped by geography, deeply embedded and difficult to change quickly. Diversification has traditionally been something to plan for, not actively pursue. The assumption has a logical basis. The U.S. refining system is the world's largest, connected to Alberta through established pipelines, and has processed Canadian heavy crude and Midwest refineries for decades. The pull is strong. Alberta's production record, however, shows that assumption is already outdated. In 2025, the province reached a record output of 4.1 million barrels per day, a 3.8% increase over the previous year, with Oilsands accounting for 84% of that volume. Alberta holds the world's fourth largest proven oil reserves at 158.9 billion barrels, behind only Venezuela, Saudi Arabia, and Iran. The Alberta Energy Regulator projects 17% additional production growth by 2033. The Trans Mountain expansion increased West Coast export capacity from 300,000 to 890,000 barrels per day. Alberta's oil exports to Asia, which were previously zero, reached 1.1 billion Canadian dollars by October 2025 alone. In roughly 18 months of new Pacific capacity, Alberta earned over $1 billion in export revenue from markets that did not exist 2 years earlier. Canada has been questioning the feasibility of diversification, and the data is already providing an answer. The Japan joint venture proposal in August 2025 did not prove diversification was possible. It proved that the Pacific region's most structurally motivated energy importer was ready to co-invest to make that diversification permanent. Most commentators in August 2025 overlooked the critical detail: the scale of Japan's urgency and the operational costs already incurred. Japan's dependency on Middle East crude fell only slightly from 95.4% of total imports in 2024 to 93.5% in 2025. That minor drop did not reflect successful diversification. It reflected declining total imports. In July 2025, S&P Global reported Japan's crude imports from the United States surged more than 19-fold in a single month as Japanese refiners scrambled for non-Hormuz supply amid rising regional tension. 19-fold in 1 month from a country that had previously imported negligible U.S. crude. This was not a measured strategic adjustment. It was an emergency. The situation became structural in early 2026 when the Iran conflict placed the Strait of Hormuz under active military pressure. Japan, sending 93% of its crude through that corridor, had to reroute roughly 60% of its May crude shipments via alternative routes. Saudi Arabia's Yanbu port on the Red Sea, the UAE's Fujairah terminal on the Gulf of Oman, and spot purchases from Central Asia and Latin America became necessary. Japan's prime minister publicly confirmed the country had sufficient supply into the following year. Financial press coverage recognized that the margin was tighter than comfortable. Reframed through Alberta's geography, the Trans Mountain pipeline carries Oilsands crude to the West Ridge Marine Terminal in Burnaby, British Columbia. The Pacific crossing to Yokohama spans approximately 8,400 kilometers. No Strait of Hormuz, no Strait of Malacca, no South China Sea choke point systematically monitored since 2013. A direct Pacific route connects Japan, whose industrial economy is only a geopolitical rupture away from a supply crisis, to volumes that the new West Coast pipeline, designed by Alberta and Ottawa, could lift to 1 million barrels per day. Japan's refining sector lacked not motivation, but the coca unit. The proposed joint venture's practical implications for Canada are significant. Ottawa spent 2 years absorbing trade pressure from a U.S. administration treating Canadian energy as a bargaining chip. The 10% energy tariff, annexation rhetoric, softwood lumber ultimatums, rare earth demands, border threats, all operated on the assumption that Canada had no viable exit from the bilateral relationship. Alberta's 90% American dependency was structural, not political, and no Pacific buyer could process Canadian heavy crude at scale through a route bypassing U.S. refineries. Japan's approach dismantles that premise in capital terms, not diplomatic messaging or press releases. A nation of 125 million, running the third largest economy on Earth, with 93% of its crude passing through a threatened corridor, is now proposing to co-invest in the infrastructure needed to replace part of that supply with Alberta Bumin. The investment is not for a temporary purchase. It funds the refinery modifications that make the acquisition permanent. Norway navigated the closest parallel to Canada's current turning point. During the 1970s and 1980s, Norwegian oil production expanded under structural pressure to remain tied to European buyers, dictated largely by proximity and existing infrastructure. Oslo's response was not to accept those limits as permanent. Norway invested in pipelines, a tanker fleet, and refining partnerships that enabled simultaneous access to multiple Atlantic markets. The government pension fund, Global, now the world's largest sovereign wealth fund, stands as a record of resource sovereignty achieved when a producing country refuses to let geography dictate leverage. Norway built it through decisions that seemed politically costly at the time. Defending domestic resource pricing against buyer pressure, making infrastructure investments that caused years of friction before generating revenue, and treating energy exports as long-term strategic assets rather than short-term commodity sales. All these decisions were difficult then and obvious in hindsight. Alberta possesses everything Norway had, and in many ways, more. Its proven reserves of 158.9 billion barrels exceed Norway's North Sea reserves by more than 10 times. Production at 4.1 million barrels per day ranks among the largest of any single jurisdiction. The Pacific geography offers the shortest ocean crossing from North America to Northeast Asian ports, at least as advantageous as Norway's North Sea position relative to European industrial centers. Until the Trans Mountain expansion, Alberta lacked West Coast pipeline capacity to convert geography into market access. Pending the new pipeline, formally committed to by Canada and Alberta on May 15, 2026, Alberta still lacks the volume throughput that would make a $100 million Japanese coker investment commercially rational at scale. That pipeline changes the equation. The May 15th federal-provincial agreement set a goal of submitting a full pipeline proposal to the Major Projects Office by July 1st, 2026, with federal designation as a national interest project targeted for October 1st, 2026 under the Building Canada Act. Alberta has explored 3 northern routing options, reported by Bloomberg in April 2026. A potential construction start in September 2027 represents an optimistic scenario, which CIBC analysts in May 2026 correctly describe as best case, contingent on resolving British Columbia's northern tanker moratorium, completing Indigenous consultations along proposed corridors, and finalizing regulatory designation. Sovereign wealth funds have expressed readiness to take 15 to 30% minority stakes. This is not speculative. It is capital prepared to move once the framework is confirmed. Challenges remain. British Columbia's government and a coalition of coastal First Nations have registered strong opposition to lifting the northern tanker ban. Their concerns reflect legitimate environmental risks associated with heavy crude shipments through sensitive northern waters. These are political and legal questions requiring negotiation with Indigenous communities holding treaty rights over the affected territories. The coker unit talks with Japan are, by all public accounts, at a preliminary stage with no final agreement. The refinery investment required to make the volume commitment commercially viable depends on the pipeline, which faces challenges that no government timeline has yet resolved. What has already changed is clear. Regardless of how individual pieces unfold, Japan's energy ministry has formally identified Alberta's oil sands as a credible structural solution to its Hormuz exposure. This identification did not result from Canadian diplomacy. It came from Iranian missiles, a Hormuz risk score of 6.4, a 19-fold emergency surge in U.S. crude purchases in a single month, and the realization that 158.9 billion barrels of proven reserves, 8,400 kilometers of unobstructed Pacific Ocean from Yokohama, was no longer merely an option. It had become a necessity. The question is not whether Alberta can supply Japan at scale. The production record of 4.1 million barrels per day, the existing Trans Mountain capacity of 890,000 barrels per day, and the planned West Coast pipeline expansion to 1 million barrels per day answer that. The question is not whether Japan has the motivation to make this relationship durable. The Hormuz risk score answers that. The question is whether Ottawa recognizes the significance of Japan's coker unit proposal. Not a trade diversification story, not a diplomatic announcement, but the opening move of a Pacific energy architecture, reorganizing around Canadian supply, and whether Canada positions itself as architect or as a reluctant participant. The window for that decision is open, but will not remain open indefinitely. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.